Hello, and welcome to our webinar, The Ultimate Forecasting Tool to Help Your Business Survive. That's a fancy way of saying we'll be talking about cash flow forecasting and how to build your own cash flow forecast. Thanks for joining us. My name is Mohini, and I'm on the content team at Gusto. I'm here to introduce your illustrious hosts. First, we're joined by Andy Smiles. Andy is a bookkeeping and small business finance expert. She's also one of the top contributors on Gusto's small business blog. We're super excited to have her with us. We're also joined by Blake Oliver, who is a CPA specializing in cloud technology and the co-host of the Cloud Accounting podcast. He's also director of marketing at Giraffe, our forecasting and planning partners. Andy, Blake, and I started collaborating on the cash flow forecasting series a few months ago, and we're super excited to finally share it with you. In addition to our template, we have a 3-part article series that teaches you how to build and use your own forecast. All the links will be included at the end of the presentation, and you can also find the articles at gusto.com/blog. Here's a quick agenda of what we'll tackle today. We'll go through some forecasting basics, then get to the fun stuff, which is seeing the template in action using a case study for a couple different scenarios. Next, we'll take some questions, and then we'll tell you a little bit about how Gusto and Giraffe can help your business further. Without further ado, I'll let Andy take it away.
So before we jump into the actual template, it's helpful to understand a few terms to get some background on what cash flow forecasting is. So what is cash flow forecasting? Before we even talk about what this process is like, it's helpful for us to define a couple of terms. So cash flow, important term for us to define. Cash flow is the actual cash that comes in and goes out of your business in any given period. So it's the cash, the actual cash you have to pay your bills, your inventory or manufacturing costs, your payroll, and your debts. So there are 2 states of cash flow. There's positive cash flow, which means you have more cash coming in than going out. And then there's negative cash flow, which means you have more cash going out than coming in. One thing to keep in mind, and you're going to see this as we go through the forecasting template, is sometimes you can have negative cash flow, but still have a cash reserve. So you may have negative cash flow 1 month, but that doesn't mean that the actual cash that you have is 0. So just keep that in mind as we go through the template. But also keep in mind that if you have too many months of negative cash flow, even if you have a cash reserve, eventually that will start eating away at it. Another thing to know is that cash flow is not profit. So you can be profitable and you can have a profit, but you can still not have enough cash to cover all of these things we've talked about, right? So things like paying off your debt and liabilities, paying your bills, taking an owner draw distribution, all of these things are not accounted for on your profit and loss statement. So you may find yourself having a profitable business, but also feeling like there's never quite enough money to cover everything. And that's when we talk about cash flow. Now we're going to talk about forecasting. Oops, we went a little too far. Yes. So forecasting helps you predict how much money will come into your business based on different factors and if there'll be enough to cover your expenses. So this is where we're really going to look at the balance between profit and cash flow. And this goes beyond just looking at sales projections. So a lot of times when people think about forecasting, they really think about just forecasting and projecting out their sales, and they don't actually look at their financial system or model from a holistic point of view about how your sales and your revenue model will affect things like your staffing needs, your capital expenses, your operating expenses. Right? So in our forecasting model, we're really taking a step back and looking at the interplay of all of these different sections and pieces of your financial system holistically to build a sustainable model. Go to the next slide. So why is cash flow forecasting so crucial right now? Well, roughly half of small businesses only have 6 months of cash flow left to keep their businesses operational, right? And as we've seen in the COVID-19 pandemic, we have officially hit 6 months into this. So this is the point where people are starting to really feel the cash flow crunch. And so this model can help you predict when you're going to run out of cash, first of all, but also when you're going to need additional assistance and how that additional assistance will help your cash flow. Worries over financial resources running out, 23%, and customers being afraid to return, 21%, are among business owners' top concerns this summer. So again, this really ties back into cash flow and forecasting, what am I going to need and what will happen? What can I do if my customers don't come back and I'm only operating at 50% capacity or 75% capacity? And then spending at local businesses is down 21 to 50%. So we are seeing drops in revenue with businesses. And this is all why thinking through the future and having a model that really addresses these concerns proactively before we're in the middle of it can really help your business survive and weather these storms. Okay, so what are the questions forecasting can help you answer? First is, do I have enough revenue to stay operational? For how long? That last slide, a lot of people are wondering this very question, like how long can I stay afloat in the current economic climate? Cash flow forecasting can help answer that. Can I hire more employees or contractors? If not now, when, right? At what point do I have the need for more staff? And then at what point can I afford the additional staff, right? And what's the balance between those two factors? And when should I apply for a loan and how much? And I will even add to this, how will applying for a loan, how will taking out a loan affect my future cash flow needs? So we're going to be talking a lot about sort of like accountancy terms. So before we get into the model and I start throwing out all these words, we just want to make sure that everyone is clear on what things mean. So revenue, when we talk about revenue, we're talking about the income from your business activities. So revenue is the income from business activities, and this is before costs and expenses. So this is before we start to take out those pieces. When we talk about workforce, we're talking about the people that you hire to run your business. And really in the model that we're going to work with, these are going to be employees, because you'll see we'll talk about subcontractors a little in a different way. So really we're talking about the employees, the people that you need to have on board in order to, maintain your business operations or even scale your business operations. Cost of goods sold are the direct costs related to selling your product or services. So for products, this tends to be manufacturing costs like raw materials and labor, and inventory costs. So if you buy merchandise that you then resell, that initial purchase of the merchandise is your cost of goods sold. And for services, it could be things like outsourced labor that you have for the service. It could be things like certain hosting that you might pay. Operating expenses are the expenses of running your business. So what's important is that these expenses are not your cost of goods sold, and people often get these two confused. So a good way to think about this, right? If we are an online store, like an online boutique, our inventory, so the merchandise that we purchase to sell on our online store, that's our cost of goods sold. The expense that we pay to host our store on Shopify, right, which is not directly tied to selling a product, that's going to be an operating expense. Capital expenses are investments that you make in your business, and typically they're in the form of assets. Not always, but typically, especially in the model that we're going to go through, where we're going to show up as assets. So what's an asset? An asset is everything your business owns. So assets can be fixed, which is like purchasing property or equipment or tools, vehicles, or they can be intangible. So intangible assets are things like trademarks and patents. So they're not actually something like physical that you can touch. And liabilities. So liabilities are what your business owes to other people, right? So these can be loans, these can be bills to your vendors, and these could, yeah. So let's go to the next one. All right, so we have this amazing template that we have co-created together. It is so cool. I believe that they're going to drop a link to the template in the chat so you can download it. It's totally free. And if you want to download the template as we're going through it and follow along in your own template so you can do as you watch, then go ahead and download the template. If you are opening the template and you notice it's view only and that you cannot actually edit inside the template, it is because we've set it to view only. All you have to do is go to File, make a copy, and that will copy an editable version into your own Google Drive. So if you're worried about it not working and you're trying to type it in and nothing's happening, go to File, make a copy, and that will give you your own editable template.
Hey, Andy, before we go on, I just wanted to jump in because I saw a question come in.
Mm-hmm.
It is really relevant, and it's a good one. Annie is asking if you could clarify cost of goods sold for versus operating expenses. So COGS versus operating expenses for a service-based company. I know this could be very confusing, right? What is cost of goods sold? You mentioned it, some examples of that, but maybe another would help to illustrate. One that I can think of, Annie, is let's say you resell subscriptions to something, right? I think the example here in the template is it's a marketing agency, right, Andy?
Mm-hmm.
Design consultancy. So let's say they're reselling subscriptions and there's like a one-to-one correlation between subscriptions and customers. The cost of that subscription then is directly related to that revenue. So that would be something that could go in cost of goods sold. Whereas if you just have a Zoom subscription for your entire company, that cannot be directly tied to revenue. So you would not include that. I hope that helps.
That's a great, that's an excellent example. And it is cost of goods sold or cost of services is really confusing. So if you are confused by the difference between that and operating expenses, you're not alone. This is one of the more confusing kind of delineations.
It's a gray area too, and different companies may do it different ways. When I had my bookkeeping firm, I actually included most of the wages of my bookkeepers in cost of goods sold. But I kept a certain percentage, 10 to 20% out, and put that into operating because that was admin time where they weren't working directly on clients. I made an estimate.
Yeah. I just see a lot of questions as well in here around accessing the template. So I believe we're putting it somewhere. Maybe Moini, you can speak to that.
Yeah, I'm sorry. I'm actually not able to access this while I'm sharing my screen, but I can drop it in when you get started sharing the forecasting template, if that's okay, Andy.
Or drop it in the chat, perhaps.
Or yeah, if like you're able to, that would be amazing.
Let's see. Do I see that? I see Q&A. I don't see the chat, actually. It might be disabled.
Oh, got it. Okay. I'll try and troubleshoot that on my end if you want to keep going. But once you are sharing your screen, Andy, I might be able to drop it in for folks.
Great. Yeah, so let's just keep going. And sorry, friends, we will definitely get you the template at some point in this thing. But for now, we're going to keep moving along because we have a lot to cover. So next slide, please. All right, so today we're going to be using the template for a case study so you can really see it in action. So our case study is Marketing is Fun, which is a digital marketing agency. Okay, so a little bit about Marketing is Fun. So you kind of get like the idea of who this business is. So Marketing is Fun provides project-based website design services and retainer support for SEO support and Facebook ads management. So currently they have 5 employees and are planning to build out their team in the next 18 months. So their business goals are to increase their website visitors by 1,000 per month, because this directly impacts their revenue. And we'll talk about that when we get into the template. And they also want to obtain 1 new SEO management retainer client per month and 1 new Facebook ads management retainer client per month. So basically, Marketing is Fun is starting to realize that to have a more sustainable and predictable business model, they really want to shift from like one-off project work into a retainer model. So they're going to be modeling based on this goal, this larger overarching goal of how they're going to shift their business model. Okay, so let's talk about the time frame. We are actually going to pretend like we are in the fall of last year. So we're pretending like we're Marketing is Fun and we really want to project out our income for 2020, right? So we're not here right now, we're almost a year ago, and we're working on our financial model. So what we're doing is we're using this template to grow and to scale. So what we're going to cover in this modeling is we're going to project our revenue based on our business goals. We're going to look at hiring decisions and timelines, and then how that's going to affect the overall model as well as our cash flow. And then we're going to look at how we can adjust the model for profitability. All right, so now it's time for me to share my screen. I'm going to share this screen here, and hopefully everybody can see it. So here we are on the template. Now you're going to see on this template to start off that there is a prep sheet. So the prep sheet already has a lot of stuff filled in. So if you are unsure about how to fill in this prep sheet, Article 1 of our cash flow forecasting series goes through what each of these mean. I'm going to go through them very quickly, but to really get the details of it, you can use that article. It's like a step-by-step. So the first part of the prep sheet is we have our revenue. So you can see here that we've already put in the revenue that we talked about. We have web design client, SEO monthly retainer, and Facebook ads. We have the price of the service. So this is what they're currently charging. We have the cost, right, of the service. So this is the cost of service that we've been discussing, cost of goods sold. And then we have the current monthly quantities sold. So this is all just the current baselines. We're not doing any adjusting yet. We come down here, we have our workforce. So we have the 5 employees that Marketing is Fun currently employs. We have their annual salary. And if somebody is a current employee, their start date is month 1, because we want the model to include them and to automatically bring them in. And then we have some of these employees that Marketing is Fun is thinking about employing. They're not quite sure when. This is kind of like in their ideal dream world. And so we have TBD. We have our benefits expense of salary, which is 20% for Marketing is Fun. We have when we pay our costs of goods sold. So this has to do with accounts payable. So do you pay all of your costs of goods sold immediately? Do you pay some in 30 days, 60 days, 90 days? You can put in the percentage of the total cost of goods sold that you sell in these different timelines. So if you're like, I pay everything up front, I don't have timelines, you would just put 100 in immediately. Or if you work with vendors who give you terms and give you a longer period of time to pay your bills, you can put those percentages in here. It should sum to 100. So we already have done that. Then we have our operating expenses. So we have our fixed operating expenses. So these are operating expenses that are the same amount every month. And this again are the baselines. So we just have added a few in here. And then we have our variable operating expenses. So these are operating expenses that can shift and change every month. And Marketing is Fun is not quite sure that, these are not like things that they're going to have every single month. So we have our capital expenses. So these are any capital expenses that Marketing is Fun needs to purchase based on what we call a driver. So based on something that triggers the need for these capital expenses. So a great example of this is a new hire, right? Every new hire that Marketing Fun makes, they have to buy a laptop and software licenses for that laptop, or software for that laptop. And that is about $2,000. So every time Marketing is Fun hires somebody, it costs $2,000. There's also a place for general capital expenses. So these could be things like needing to purchase a vehicle, or just a general, pieces of tools and machinery that aren't necessarily like linked specifically to a driver, but Marketing is Fun doesn't have any of these. And then we have our assets and liabilities. So we definitely want to be sure we put in cash and bank, because that is what you are currently starting this model off with. So we want to be sure that we know how much money we're starting off with cash in the bank. And then just like we talked about the cost of goods sold, we want to put down the percentage of our total expenses that we collect that we pay in 80 days, or that we collect, I'm sorry. So the total amount of revenue that we collect in under 30 days, 30 to 60 days, and 60 to 90 days. So if you have like a business model where it's like point of sale, you're like a coffee shop and people just pay you at the time of service, collected in under 30 days will be 100%, right? Because you're not waiting out for payments to come in. But if you have a business model where you invoice people and maybe you give people something like 30 days to pay their invoices, that's when here you're going to start putting in the percentage of your total revenue that comes in these different time frames. Fixed assets, and then the same here with liabilities. So what percentage of your operating expenses do you pay out in under 30 days, between 30 and 60 days, and 60 to 90 days, right? So these are all just like baselines that you're setting up. And again, you'll go through this yourself. So now what we want to get into is the actual, forecasting piece of things. So I'm going to come over here to this tab called Revenue and COGS. And this is where we start. I'm actually going to close this Q&A so I can see the whole screen. Okay, so we see here that we have our 3 lovely revenue streams. Now I click on this little plus. What I see is the starting price and the starting quantity. So we have our starting price, starting quantity, and this will automatically update once we start updating these cells. But for now, we're just pulling off of the prep sheet here. So we're just pulling our baselines, and from there, we begin to adjust based on our goals. So remember how we said marketing is fun. Their goal is to increase their website visitors by 1,000 people per month. So they want to, every month, they want to slowly build up their web traffic, right? Because they've realized that for every 1,000 people who visit their website, new people who visit their website, there's going to be 5 of those people convert into this web design new clients. That's kind of how they start to work with people, right? Is that their traffic is directly linked to new clients, right? So this is a very simplified model. Obviously, if you know a lot more of your metrics, like your conversion rates and stuff like that, you can get more detailed with this, but we're keeping this very simple. So for every 1,000 people who come to Marketing is Fun website, new people, right? And their goal is 1,000 new people a month. So they're building their traffic. They're gonna have 5 new clients, right? So here's what we're gonna do. We're gonna say, okay, month 1, having our baseline. Month 2, we're gonna do 35, right? Month 3, 40, because we just know, like, if we hit this goal that we have set for ourselves, we will increase every single month. We're gonna be slowly increasing the number of new clients that come into our web design, right? So 45. And now, because I don't wanna sit here and type these all in, I'm actually gonna begin to put in a formula here, just so I can get this through quickly. And you don't all have to watch me pull in, type things in over and over. So we see now, as we have increased our goal, right? As we're hitting our goals, what we're seeing here is that our revenue is slowly going up, right? So we're seeing this revenue, this model start to get built out. So next, we're gonna come down here to the SEO and monthly retainer. So we said that Marketing is Fun every single month wants to just add 1 new retainer client to their business. That's all they want to do. They feel like that's like a reasonable thing that they can do. Again, if this could be more complex, it could be based on the percentage of conversion of new clients into retainer clients. Like, there's more ways that we could make this complex, but we're just going to keep things simple. So we do 6, we do 7, and then again, I'm just going to make a formula so we don't have to sit and watch me type a bunch of stuff in. Okay, so we're starting to see how this impacts Marketing is Fun. And the same is true with the monthly retainer. So again, their goal is just to add 1 new Facebook ads monthly retainer each month. We do 6, we do 7, and then we just do a quick formula. And we pull this over. So now we're seeing the revenue model built out. And what will automatically happen down here is our cost of goods sold will also adjust based on our revenue, right? Based on how many we're selling. Now, you can adjust these numbers too. So you don't have to automatically link it to this. If you don't want to, you can always come in here and adjust, you know, these cost of goods sold numbers. If you know that in month 2, you're going to buy a bunch of inventory and that's going to last you for the next 3 months, you can definitely adjust these numbers here. But for this model, again, we're going to keep things really, really basic and just simply have our cost of goods sold reflect whatever quantities we're selling up here. You can also decrease your cost of goods sold. So if you find out a way to decrease the costs of your service or your products, you can also adjust that here, and that will adjust the model. Again, we're not going to do that because we're just trying to keep things very, very simple. So now we have the revenue model built out. So we have, we're seeing this increase in revenue. So we have the revenue model built out. What's next? Next, we're going to come over to the workforce. Because the thing is this looks great, but at Marketing is Fun's current capacity with employees, they cannot sustain this, right? There is no way that they can suddenly have 95 web design clients and 36 retainer clients. There's no way they can do that with the 5 people they have on staff. So the next step is to think about, okay, given if this were the model, at what point would I need to hire somebody? So if I come here to the workforce, we see here that I've actually put in these numbers 25, 25, 15. I wrote these in to demonstrate like capacity for each employee, just to make it a little bit easier. So we have 2 designer and developers, and we know we want to hire a third one. The 2 designer and developers together can handle 50 projects, right? They each can handle 25. So they can handle up to 50. So now what we do is we come back over here and we start to look at what point do I need to hire a new designer and developer, right? It's at month 5, I'm at 50 projects, which means I probably want to hire that person in month 4. So I have some onboarding time, right? And some training time. So we're going to come back here to workforce, and under designer and developer, we're just going to type in month 4. And we see here that now the costs of this person's salary get added into our model. So we're going to do this for our SEO Facebook Ads Manager. We have 15, right? Our current guy can handle 15, and we know we need to hire more. So if I come back here, at what point do I hit 15? Well, I hit 15 in month 4, right? Because it's 8 and 8, 16. So in month 3 is when I need to hire this person. So we're going to come back here. We're going to hire our first one in month 3, right? So now between our 2 SEO Facebook managers, we can handle 30 folks, right? 30 people. And then we just continue this process. So at what point am I over 30? Well, I get there around month 11, right? So now I'm going to hire again in month 10. So it's a little bit of a holistic process. So it isn't so straightforward that you're just kind of like, this is when I hire somebody. There's a little bit of back and forth that you're going to do. And I'm going to go ahead and just type these in. And then let's say like project management and admin support, just looking at this model because they're not directly tied. It's more about when do we start to reach our capacity. Looking at this model, let's just say, okay, I'm going to do project manager at month 8 because that's when things start to get to be a lot to handle. And I want to do admin at month 6. So I'm going to come back here and type in month 8 and month 6. And here we are. So now we have all of our staffing costs, and we see our benefits are going up. Our benefits expense are going up because we have more staff. Operating expenses.
And I just want to add one thing, Andy. I know that some of our viewers are thinking to themselves, this is kind of manual, isn't it? And I just would like to say that I'm going to show you how you could potentially automate a little bit of that, link your workforce to your revenue and number of clients. We decided not to do that with this model because it can get very complex very quickly, and not every business is set up in that way where you have, say, a number of clients and you need to then hire workforce to satisfy those clients. So we deliberately did not do that, but I'm going to kind of give you a preview of how you can customize this later.
Yeah, you don't all have to do it automated, but we're trying to keep things simple and accessible for folks who are not super familiar with Google Sheets and don't want to watch us do a bunch of formulas in here.
And we figured this is probably complicated enough given we're doing 3-way financial statements in a spreadsheet here. So
yeah.
Okay,
so let's talk about operating expenses. So how about office software? Let's say, again, because we're beginning to see how everything works together. So let's say, okay, all of these expenses don't really change that much and when I hire somebody, but when I do hire somebody, my office software expenses go up because for every new hire, I have to pay $200 or more in user licenses. So again, this is where we begin to adjust the model. So now I know when I'm hiring people, right? Because I've figured that out based on my revenue model. So we're kind of like bucketing down. Tiering down maybe is a better way. So now I'm going to begin to adjust my office expenses. So here, I'm adding $200. And then in month 4, I have another hire. So I add another $200. Oops, $1,400. And then in month 6, I add another. And then in month 8, I add another. In month 10, I add another. And in month 18, I add another, right? So we're beginning to realistically project our costs. We come down here to variable expenses and we're looking at advertising, right? So advertising, earlier we said marketing is fun is going to increase their website traffic by 100 people or 1,000 people per month, right? How is that going to happen? Right? Like what are the costs associated with that happening? So maybe it's doing marketing and advertising. So again, we're just very simply, let's just say every 1,000 people costs $1,500 for marketing is fun. So every time marketing is fun increases their website traffic by $1,000, the cost to them increases their marketing budget by $1,500. So now that's what we want to do, right? So every single month, we're going to reflect that here in the model because what we don't want is to forget that we have additional expenses and think, woohoo, this whole model is working and realize that we've missed something. So again, I'm just going to pull this over so we don't have to watch me type a bunch of stuff in. And we're seeing every month the advertising budget increases as the revenue increases. And then finally, we have subcontractors, right? So subcontractor costs, sometimes the costs don't go up, they go down. So for marketing is fun, every time they make a new hire, their subcontractor cost is going down because suddenly they're not relying on contracted labor. They're just relying on their employees. So in this model, we can begin to say, okay, well, with every new hire, the subcontractor costs are going down $2,000. So again, every time we hire somebody, we're beginning to reduce our subcontractor costs. So it isn't always that when something happens in your business, when your business is growing, that your costs go up. Sometimes your costs are going down. And finally, we have hiring costs, right? So again, this is tied to every time we hire someone, it costs $1,200. So we hire someone in month 3, we're going to add $1,200. We hire someone in month 4, we hire someone in month 6, we hire someone in month 8, we hire someone in month 10, we hire someone in month 18. So now we've built out our expenses tied to the things that drive our revenue projections and our staffing needs. So let's move over to capital expenses. So capital expenses, if you remember here, every time marketing is fun, hire someone, they pay $2,000. Right? And buying the laptop for their new employee. So if we come over here, again, we are going to enter that in here. So on month 3, $1,200, month 10, $1,200, month 4, right? Because this is all cash that's going out of, Marketing is Fun's bank account. So what we want to do.
1,200 or 2,000?
Oh, 2,000. Thank you. I was on the hiring costs. It's like, yeah, I was like, why does it say 2,000 all the way over there? And we have month 8. I'm missing 2,000 and month 6. All right, so here we are. So now we've accounted for all of the inflow and outflow based on the revenue model changing, the hiring model changing, and the changes that would happen in the operating expenses. So now it's time for the big reveal. Is this model going to work? Is this model going to work for Marketing is Fun? So we come here to the profit and loss report and we see, okay, here under my net income or loss, I'm seeing some growth over time, but my very first month I'm taking a loss. And to be quite honest, Marketing is Fun is like, this is not enough profit for me. So in this situation, right, we need to think about, okay, like, are we okay with taking this loss in service of like the larger business model, or do we need to make some adjustments, right? So in Marketing is Fun wants to make some adjustments. So Marketing is Fun is like, what happens if I increase the price of my services? Like, how is that going to impact my profit and loss? And also my cash flow? Because we come over here to cash flow, we're starting to see that Marketing is Fun is running negative cash flow for 3 months. Month 4, you know, we have some, we're still negative cash flow, and then we start to pick up after 5 months. But this is making Marketing is Fun pretty nervous. Like, it's like, oh, I don't know if I want to do that. So if we come back over here to revenue, we're actually going to increase the price. So instead of it being 1,000, we're going to do 1,200 here, right? We're going to bring all of this over here. And then we're going to increase the retainers. So we're going to increase the retainers to 4,500 for each one. And we're just going to see, how does this impact it? Because maybe what I need to do is increase my prices. So now we can come back here and nothing else really changes, right? Because we've only impacted the prices. So the staffing remains the same. The operating expenses remains the same. But if I come over here to my profit and loss, this is looking a little bit better for Marketing is Fun, because now that first month, Marketing is Fun isn't taking a loss anymore. And we begin to see that more steady revenue growth that Marketing is Fun is looking for, because Marketing is Fun really wanted revenue growth to look like this and not how it was looking before. We can also come over here to the cash flow, and we see that we're once in month 5 was when we finally recovered. We're now recovering out of negative cash flow in month 3. And because Marketing is Fun has $1,000 cash reserve, it actually can withstand this negative cash flow, right? It actually can withstand it. And then here in month 3, it begins to rebuild its cash reserve. And then it begins to, over time, you know, you'll see the cash reserve go up. So that is how we use the model for growth. And now I'm going to hand it over to Blake.
All right. Wonderful, Andy. Thank you for, I don't know how you do it, but you make financial modeling and cash flow forecasting actually easy to understand, relatively speaking. So thank you. Let me go ahead and share my screen and hope that this works. And I see there are questions coming in. A lot of it has to do with, you know, customization. And that's what I want to talk to you guys about. I want to talk about what happens after you build the model. You know, especially in a situation where you're losing revenue. In a recession, perhaps you lose half your clients. And now the question is, well, can I get through with the staff I have, or am I going to have to furlough people, do layoffs? Do I need to take a loan? This is where a model can actually come in really, really handy. So a lot of the customization kind of goes in with that, is, you know, how do we change this model to fit our specific business, and then also if things change. So let's go ahead and play around with it, and I'll do my best to answer the questions that have come in as they come in. So first, I did want to answer a question about the revenue. So this revenue tab here, and you're seeing my screen, right, Andy? We're good on that? Okay, cool. Thumbs up from Andy.
Yeah, we see you.
Okay, so let's just kind of like take a look at the overview of the structure of how this thing works. So your 3 financial statements are your profit and loss, right? This is very simplified: revenue, cost of goods sold, fixed expenses, variable expenses, net income loss, but like very simple. Then we have the balance sheet, right? And then we have the statement of cash flows. So you might worry about breaking things when you're customizing your spreadsheet. This number here at the bottom should always be 0. This is our check sum. It makes sure that our assets and our liabilities and our cash all ties out. So if you change things and this number is still looking good, chances are your model is okay. If now there's a value in here, you might have screwed something up. So I always recommend going to File and make a copy. And every time you're going to do something with your model, copy the whole spreadsheet, give it a date in the file name or some way that you can distinguish the changes you've made. And it's always a good thing to do that every time you're updating it, just as a best practice. So let's talk about customizing. Let's say you have a revenue model that's different than this one. Kind of makes sense, right? You can customize this table to your heart's content as long as it all sums up into this total revenue category. So see here, we've got, if I double click in, you can see the formula. It's just a sum of line 10, 15, 20, and then we've got one more here, I think. We got an extra one actually that you could use, right? But you could easily go and customize this farther. So we'll say service number 4, and then maybe we'll duplicate it, right? So we'll say copy all those, edit, and we'll insert the rows. We'll just insert a bunch of rows. Insert 4 above, copy, paste, ta-da, right? And then we can change our formula to, I think I'm pulling in some cells here, so I'm not going to do it right now. I'm pulling in some values from the spreadsheet, and I can go figure it out, but I'm not going to do it now. And then we could just go and add in the, the missing value here. And now we've got an updated revenue amount, and that'll all flow through into your financial statements. So you can play around with that. One thing I want to do is talk about coronavirus, COVID pandemic. Let's say we want to adjust this model to show that there is a revenue decline. How could we do that, right? So let's go ahead and add a cell here, and we'll change the formatting. And we could call this, actually, you know what? Let's do it down. Yeah, let's do it up here. This is good. So we'll call this, COVID factor. And I got to make sure that I change my text color. And we're going to say that starting around month 5, perhaps it might help also to label these months. So I could say, let's see. I'm going to go ahead and say that we've got, January, February, March, April, May, that sort of thing. So let's say that starting in April, we start to have a revenue decline. We say we have let's say a 50% drop in revenue, but it's 100% up to this point. And then I've got a drop. And we'll say, I don't know, let's see, will this work? There we go. We're going to have this drop through August, and then things are going to start to improve. So gradually our revenue is going to go up again to 80%. Let's make sure I get the formatting here. So what I want to do is I want to tell my revenue to adjust based on this, right? I'm just going to adjust total revenue. And actually, I could probably just slide this down here. There we go. So all I got to do is click in to my cells here. And I'm going to say, I'm going to sum these guys up with the sum function and then multiply it by my COVID factor there. And I don't know how well you guys can see that. So I'm summing up the individual product revenue and then multiplying it by my COVID factor. And then I'm going to drag this all the way over. So there we go. So now I've adjusted my revenue, right? Now my revenue is dropping here. Now cost of goods sold hasn't changed, right? Because I didn't change the quantity of the folks coming in. And actually, you know what? I changed my mind. I'm going to go ahead and I'm going to affect the quantity of the revenue subtotals. I could actually change this instead. So let's say, because I'm going to lose clients, right? So let's go ahead and undo my sum here, and I'm going to go ahead and open up these guys instead. And I'll pull my COVID factor back up to the top. And I'll just simply say that we'll start with 30. We'll start here, and let's say, here we go. Let's see, we had a formula in here. It's going to be +5 every month, right? So maybe I'll say this. I'm going to say insert one above here, and I'm going to say equals 50% times 45. So now we have a drop. I'll format this guy as a number here. So we're still going to have growth, right? But we're limiting the number of customers we have, right? And then I just need to change this formula. And now I've got my new revenue target here. So you can see how that's going to affect the model. I mean, we can do that across the whole thing. We could insert rows. We can customize this to our heart's delight. So you get the idea here. So I'm going to go ahead, though, and do total revenue because I don't have the time to go ahead and customize the model for the whole thing. So I'll just go ahead and do what I did before. And now we've got a revenue decline, right? And let's say this goes back to 90 and then 100. Oh, thinks that I'm doing not a percent. So let's see what happened here on the P&L and on the statement of cash flows. Okay, we've got a problem here, right? So this is where I always go when I'm adjusting my model is I want to see what's happening with cash. So you can see starting in month 5, which is when I had that revenue decline, we've got negative cash flow now because we haven't made any changes in the hiring. We haven't made any changes in expenses. We haven't cut expenses. So, but this is actually kind of good news, right? Because we can see cash at the end of the period goes down to negative $80,000. So let's say I didn't want to make any changes and I just want to weather the storm. I could go ahead and I could take a note for, say, $100,000, take a loan and get through this. And so I can go to my balance sheet here and I can go to notes payable. And we've got this little plus and minus symbol here. And we could go ahead and say, I'm going to take a loan for $100,000. Oh, that's $100,000 starting in month 5. And now I actually only am going to go down to $21,000 in my cash by month 10. And then I start building up again. And so, of course, I can also put in repayment terms here. So I've increased it by $100,000. And I could say, let's say that we are going to decrease it by $10,000 for the next 10 months or something like that. Of course, your actual loan terms would be very different than that, would include interest and whatnot. But for the simple sake of this model, we're only going to do that. So now here I've got the loan coming in month 5, repayments going out to month 15. And we can actually see that we don't have the cash to repay the loan that quickly. So maybe we need to do it more slowly, right? And we could say, okay, let's do 5,000 per month and just take that out. Our model doesn't go far enough to do the whole thing. And we can see, hey, we're almost there. Cash at the end of the period for month 10, negative 4,000. Maybe let's look at workforce. We could change our workforce hiring plan, right? And so we could say, we're not going to hire that developer. We actually don't need all those people because we've got half the clients. So maybe we push this out to month 8, right? Something like that. And now we go back to our cash flow and we look and we see, oh, we're doing okay. So I know that was very quick, but I hope that helps to illustrate how you can use a model to figure out where your cash is going to be, how well you're gonna do in a downturn and all that. There's lots of ways that we can tie together like the revenue and the workforce and the operating expenses. You can get really fancy with your model, but I think it's generally better to avoid getting really super complex formulas in there because nobody will understand how they work. For example, the most complicated formula we've got in this model is an if statement here. And honestly, if you asked me to explain this to you right now, I'd have to seriously think about how this works to figure that out, right? So that's kind of how it works. I'm wondering if we have time for questions.
Yeah, I think so. There's a couple of them that I think will be pretty quick to answer, but should be helpful for the whole group. So I can go ahead and maybe take over. But yeah, so there are a couple of just, oh yeah, like if you want to continue sharing
There
those.
you go.
Thank you. Yeah, so for our Q&A, I thought these were a couple of good questions. Two of them came in on just asking kind of what gross salaries kind of includes. So notice you have gross salaries listed. Where would additional costs for employees go, especially taxes that would have to be withheld? For me, that's actual cash flow I have to plan for. And there's also another question about whether like salary includes gross salary or payroll costs as well.
So in this model, we did the simplest thing possible, which is simply to group all of the associated expenses with employees into this benefits expense amount. And perhaps an even better term for it would be, fully burdened headcount, because that would include payroll, taxes, health benefits, just as a percentage of the gross payroll. And so you could look at your historical financials and figure that out, and then, estimate it going forward this way. You could also break it out into separate lines in the model. You could have payroll tax specifically, and you could have the benefits separate as well, as long as it like sums up and flows through into the financial statements. You could do that. But actually, one of the reasons that I've always loved working with Gusto is that I don't have to worry about holding on to those payroll taxes. Gusto takes care of that for me.
We got you.
Yeah.
Great, thank you. So there's a couple also just kind of questions about how to use the template that I think would be good to address here. So is there a way to add rows to the categories on the prep sheet that will be sure to resurface or I guess populate in the other tabs across the spreadsheet?
Yeah, what I would recommend doing is actually not trying to mess with the prep sheet. If it doesn't serve your needs, you can go directly to these other tabs and start playing around with them like I did. And again, make a copy of your workbook before you do it, so that if you mess it up, you're not going to be lost. And specifically with Workforce, for instance, one way to do this easily without really like worrying too much about the formulas is to always insert above the last row. So you see here we've got TBD5. We could go insert one above, and then copy down the formulas. So I grab this cell, I highlight the cell, and I grab the little box here at the bottom. I'm trying to zoom in, but it's not working for me right now. I grab the little box and I pull that down, and that pulls the formulas all through. And if I've coded this correctly, then I should just be able to copy across. And then I can say TBD 6 project manager, $4,000 a month, or well, I don't know, let's say 5,000. And then I could say month 5. And yes, it does work. So congrats to me for building a model that actually works.
Amazing. I'm sure a lot of other people are wondering this. Once you change a cell to no longer include the default formula, can you change it back to the default, or is it gone forever?
That's why you would want to make a copy of the workbook. I mean, you can do undo forever with Google, which is great. So I can just go up here and I can say undo, but it's much easier if you make a copy and then you play with it. And you can also see version history. So you can go to version history, and actually a better way to do it instead of making a copy might be just to name the current version. So I could call this, after Blake messed up Andy's great model, right? We should have made a copy after she built the great model. And then you can always revert to that if you want. So you see version history, and then I can always go back to that. I can actually also just go straight, see, here's the version that Andy did. And I could say, this is, before I started messing with it, I could say, this is, Andy's finished model. And then I can always just go back, restore this version.
That is a great life tip.
Yeah. Yeah, the named versioning in Google Sheets is awesome. I love it.
Awesome. So I'm just going to try and grab a couple more quick ones here. So someone asked, where exactly is the worksheet? If you go into the Q&A, Blake very helpfully dropped in the link so you can find it there. We'll also be sending around this webinar deck where you can link directly to the worksheet and make your own copy. how frequently should folks be doing this forecasting exercise?
So I'll be honest with you. When I had my own business, which was a few years ago now, I built a financial model so I could raise $80,000 to start my business. I did that. I raised the money, and then I never used it again, which is what happens with most models, unfortunately. But they can be really, really helpful to use on an ongoing basis. The big challenge, of course, is updating it, and then getting your actual numbers in a way that makes sense, and then being able to compare it. So this might be a good point for me to pitch the Jirav Gusto integration. We integrate with Gusto. So I work at Jirav. We're a financial modeling solution. You can build a forecast once you break your spreadsheet and you can't get it to work. You can build it in Jirav. It will not break. That's the beauty of it. You can connect Gusto to import your workforce data. You can connect it to QuickBooks to import your accounting data, and you can build forecasts without having to know Excel formulas or worry about it breaking and whatnot. And the best part is that you can then roll forward your model. So you import your actuals every month, update that, compare how you did to how you planned, and then reforecast into the future because it's never exactly what you thought. And you can do really cool stuff like, as you see on the slide, you can drive expenses by headcount directly. We don't do that in the spreadsheet model. You have to plug in the numbers for operating expense and variable expense and whatnot. With Jirav, you can link drivers to their outputs. We call them drivers because they drive that expense. So headcount could drive meals and entertainment. It could drive buying that laptop. And we tie out the financial statements in the same way. So yeah, you can get a free trial at jirav.com/connectgusto.
Awesome. There was one last question that I think would be cool to get to is that, can you import information from other software that you're using into the template?
So in our template, I mean, you could, there are add-ons that will allow you to pull in data into a Google Sheet. Sometimes that's more effort than it's worth. You could manually create like a tab in the sheet, and then you could pull in stuff like, website visits, and you could link that to your new customers. They could programmatically, you could, drive, you could say, here's website visits, here's my cost per lead, CPL, right? Here's my advertising expense. And you could, figure out, okay, if I spend $10,000 and my cost per lead is 100, I'm not really doing this in a very good order, but, there's my leads that I'm going to get. My close rate is, let's say it's 10%, right? So now I know that I'm going to get 10 customers, right? New customers for every $10,000 in advertising expense. So what happens if I double it? 20 customers, right? And then you could link this over to your revenue tab and change that quantity that way. So you can layer on top of this. This is really just a starting point. You can get really sophisticated with it. And I always recommend that, if you're really trying to understand how your business works, it's important to build a financial model from scratch. The idea behind this template, though, is so that you don't have to learn how to tie together financial statements. That's taken care of. You can just play around with the drivers.
Awesome. Thanks so much, Blake. Okay, so we're just about at time, so I think I'll wrap things up there. It sounds like, Blake, you were already able to kind of give a little bit of the lowdown on Jirav, but of course, Gusto is also here for all of your businesses. Gusto's people platform can support you when you're onboarding, paying, insuring, and just also supporting your hardworking team. So if you'd like a little bit more information about Gusto or Jirav, I'm going to launch a poll right now, and you can opt in to get some more information about Jirav or have someone from Gusto contact you with more information. We also have some great COVID resources for you that you can find at our COVID resources hub at covidresources.gusto.com. And as promised, all of the links to our full cash flow forecasting series are in this webinar deck, which we'll be sending out to you in 24 hours. And you can also find them all at gusto.com/blog. That's pretty much all we have for you today. Yes, thank you so much for those of you who are just like taking a quick second to answer the poll. We'd love to follow up with you for more information. And if you have feedback and would like to see more from us, someone dropped on a question already. Is Gusto going to collab with Jirav on more webinars? I think we'd honestly love to. It's been so fun. I absolutely adore working with both Blake and Andy. And yeah, we can bring the dream team back together. So you have a couple different options for how to leave your feedback. Again, we'll be emailing you the deck and the recording, and you can also reply directly to that email if you have any other thoughts or questions. Thank you all so much for joining. Thank you so much to Blake and Andy for sharing your magic with all of us. And yeah, have a great rest of your day, everybody.
Thanks everyone for coming.
Thank you.